Memorize that formula and work it out before you do your next step.
Can you just run through it for us?
Exactly. Okay, the stock options is the most available currency. You hear the word currency, you think of money or dollars. And that's what's most available to you. You can issue stock. And you can issue as much stock as you want as long as people will accept it. Of course, you can always inflate the value of the currency, right, or deflate the value by inflating the number of options. Is it the most expensive currency? Perhaps, but it's the most available currency. We'll talk about that. Why do you want to use stock options? Well, you need to attract talented people, and you don't have cash to pay them. So you pay them with stock options. Now, you want to attract talented board members. To be successful, perhaps one of the keys is the right people on your board. The right people on your board can open doors, give you great suggestions, find people to help you out. I'm a true believer in having excellent people on your board. In fact, a superstar on your board, if you can get it. Superstar is somebody whose name people know in the industry. So most excellent board members will not pay attention to a startup unless they believe in both the prospects and they get a piece of the action, so to speak. You want to attract excellent consultants, and you want to attract excellent employees. Now, an excellent consultant would be an attorney, for example. It might be a CFO. It might be an engineer. These are people who, in the market, get paid $200,000, $300,000, $400,000, $500,000 a year because they're that good, but you don't have the cash to pay them. So what else can you pay them with? Well, perhaps stock options. If they believe in your company, perhaps they will work for you, provide consulting services to you. Now, you can't put them on the payroll full time because there's not enough for them to do. But a day a month, a day a week, whatever it takes, consultants will sometimes work for less cash and some stock if they really believe in what you do. The third one is to attract excellent employees. And you need employees to be committed. Now, what kind of employees do you want to attract with stock options? Not somebody who works 40 hours a week. You want somebody to work how many hours a week? Come on, tell me, how many hours a week? 80 or 100? Well, you know, 100, that's a bit much. 80, that's a heck of a lot. That's Goldman Sachs type work. But nevertheless, I would say you want to attract people who are going to work 50 to maybe 80 hours a week, somewhere in that range. 50 on the low end, 60 to 70 hours. You want them motivated enough so that they're working that many hours. That's a lot of hours. I hope they still have a family life and social life. They should be able to integrate it. 50 hours a week is not that much. 60 hours, starts pushing it. But you want them to work hard, and the way to do that is motivate them with stock options. Why board members? I've mentioned this before. The success of your company will often depend on the quality of board members. Well, how much should a superstar board member get? I think that a superstar board member, remember, one who is famous in the field. People will give you instant credibility. That might be worth 5% of the company or more because of the doors that they can open. So don't be niggardly in terms of giving out your stock options to the people who can really help you out. Why consultants? I mentioned these before. You don't have enough money to pay them. Put them on staff at the going rate. So you use stock options to help them out. And we talked about the 50, I'm getting ahead of myself here, how hard they should work. How do I value stock options? Well, in a startup, it's impossible to set a precise value. It must be negotiated. When you're negotiating, it's often just your gut feel. But there are a few touchstones we can talk about to help you get some feel for value. You compare the value of options with foregone salary and with foregone opportunities. Everybody has an alternative to use his or her time. So how do you want to motivate that person to use that person's time for you? And that's one reason we do it. once I have the value parameters, how many options do I grant? Well, let's just run through a little scenario. You rationally calculate the value of your company in 5 years. Now, that means you have to set the assumptions that you use rationally and logically, and usually they're much lower than the entrepreneurs want to talk about. So you rationally calculate the value of the company in 5 years. What could you actually do? 5 years will be hopefully your exit, right? You're going to sell it, merge it, or take it public. That used to be the paradigm, and going public is not so much of a paradigm anymore, but merging or acquisition is an exit strategy. Rationally assess the risk profile. The earlier the option grant, the greater the risk. It is just like money. The earlier the money, the greater the risk, and therefore the greater the return. You have to look at how much additional capital would be required, because remember, each time there's a round of investment, you issue more stock, and the number of shares expands, and therefore the percentage interest in the company is diluted. What will the cap table look like in 5 years? You have to look out that far, and therefore you should have somebody who knows how to run a spreadsheet. And what will the per share value look like in 5 years? After you look at that, then you determine a rate of return for the risk profile. Some ventures are very risky, some are not so risky. You have to assess your risk profile, and then you do a present value calculation to determine the number of options to be granted. As you look at that future value, discount it back to present value based on your rate of return, figure out what you should grant at that particular moment in time. So let's take a look at an example. An employee is worth $100,000 in the market if you paid the employee just cash, but will work for $50,000 plus options. That means that that employee is investing $50,000 in your company. Assume that this company is pre-Series A funding, I mean very early, and since it's a pre-Series A funding, the rate of return that somebody wants to get out of this early investment is, say, 15 times the investment, okay? VCs want what, 10 times the money? You often hear that. So this is even pre-Series A, so you want 15 times your investment. So 15 times 50,000 is 750,000. That's what this employee should want to get in 5 years because of the risk. So target the value of your company in 5 years is $75 million. Now I'm assuming it's going to be a very successful company, okay? So I'm talking to those of you who are going to make it big because your employees are working 60 and 70 hours a week, and so are you. So the employee needs 1% of the company to achieve his target of $750,000 at the end of 5 years. Assume that there are 15 million shares outstanding at the end of 5 years, $5 a share. And so you need to grant options on 150,000 shares at the outset to allow that person to achieve his 15 times investment, or 750,000. Now this sounds very logical. I'm not sure how many people actually go through these steps, but it gives you a conceptual framework to figure out what to grant. Yes?
Why did you choose 15 million shares? Like, how do you determine how many million shares to have in total?
Well, if you get investors who invest, venture capital firms or private equity firms, they will invest at a certain dollar per share, and they are going to value the company. Now, do you want to take your company public at $5 a share, or $10 a share, or $15 a share? I put it at $5. If you wanted to take your company public at $10 a share, then you might adjust your cap table to, instead of having 15 million shares outstanding, 7.5 million shares outstanding. But if a venture capitalist invests, say, at 50 cents a share, and that investment wants 10 times return, the shares are worth $5. So it can be any number, but so you pick your target value that you think you can achieve, and then say, how many shares will it take me to get there? And I have to price them out. Now, you can sell shares at any price you want, 50 cents, $1, $1.50. These are just some numbers that are easy to remember, but they could be $1, it could be $10, it could be $25. But the same type of math would occur to determine how many options to give out to a particular employee. Now, let's look at an example of a later stage company where the risk is much less. The employee is worth $100,000, but will work for $75,000 plus options. So he's investing, or she is investing $25,000 equivalent investment. It's a post-Series D funding. You've been successful to attract 4 rounds of investment, and now the risk is much lower. You can see a path to exit. You've got market traction. You've got sales. It's increasing quite rapidly. And so how much return in 5 years should you get on a post-Series D funding? Well, perhaps 2 times return. You double your money in 5 years, and so that is a return of what? Is that a 20% return, something like that? And that might be the proper return for a late-stage funding. Once again, the value of the company is $75 million in 5 years. To achieve the target of a $100,000 return, let's see, I did my math wrong, didn't I? Oh dear. Well, let's say it works for $50,000 and invest $50,000, then the math works. So, but it's late stage, and so it's much more certain that he will get it. In that case, he would need, or she would need, 0.1333% of the company to achieve that target. Once again, 15 million shares outstanding, $5 a share, options on 20,000 shares. So take my 75 up there and put 50, and he's investing 50, and then you've got the same math. So the early stage versus late stage all depends on the risk profile and what the return needs to be to attract somebody. Okay, issues of stock option. If you are an employee and a startup company offers you options, then what questions do you want to ask so that you get the value? And of course, if you are the entrepreneur hiring somebody, you need to understand this as well. You need to know the fully diluted cap table. That means at the time the option might be exercised, what will the cap table look like? How many common shares outstanding? How many options outstanding? How many warrants outstanding? How many convertible preferred outstanding? You sort of do a fully converted, fully diluted cap table to see what it looks like. You need to anticipate your future earnings. That is, can you really grow to 75 million in sales or in value? And then based on those numbers, you can calculate the other numbers. How big is this typical stock pool? Well, 15 to 20% is sort of a rule of thumb that new companies will set aside to attract the proper talent to work with the company. The value of stock options is very much affected by the terms of the other classes of shares. If you have 4 rounds of investment, Series A, B, C, and D, all of those are likely to be preferred shares, each one with a priority over the earlier round, and they might be convertible into stock at a certain price. They might be just a straight preferred that has a preferred dividend attached, but otherwise just like common stock. You need to know what is there, because if you've got a Series A preferred, that allows a conversion at a 2 times the price or some other number. It can greatly affect the dilution. So to really value your stock options, you need to know the terms of the outstanding shares. Now, are there contractual traps? Entrepreneurs, I've seen some entrepreneurs who want to assure themselves non-dilutable shares. They want to maintain their 25% forever. It never works. It's just a big trap, and you might really fail to be funded if you want to do that. But I occasionally see anti-dilution clauses for some shareholders, meaning that their percentage interest always remains the same, which means all dilution hits the other shareholder class. Buybacks. If you have options, does your option contract allow the company to buy you back at a certain price? That's not very good. It limits the upside. Anti-compete clauses. You have an option, you've worked for several years, some of it's vested, but you want to go work for a competitor because you're offered a better deal. What happens to your options? Is there a buyback clause that prevents your upside? So those are sophisticated issues that people need to look into. Vesting. Typically, an option will vest over 5 years, but it doesn't have to. It can vest at any number of years. So, for example, if you hire a consultant to do a very important job for you, and that consultant completes the job in 6 months, 12 months, 15 months, that consultant will probably insist on full vesting of any options he gets because he's delivered the value. When the employee delivers the value, then they should vest. That's one way to look at it. For employees, you want them to stick around for a while, so it's 5 years. Perhaps no vesting until the first year, and thereafter it vests on a monthly basis. And if the employee stops or quits or is fired, then the vesting stops, and all of the options are canceled that haven't yet vested. If there's a non-compete, you say if you compete, your vested shares will simply be worth 0 or we'll buy them back. Now, by the way, in California, we have a pretty strict non-compete law, and so it's hard to enforce anti-competition laws, anti-competition clauses. So if you can do that in California, you should really look at consult with an attorney. Acceleration of vesting. If you're so successful that the company is sold within 3 years, but yet you have a 5-year option, you probably want accelerated vesting because you've achieved the goal, right? You've achieved an exit that's worth a whole lot. So look at whether you have an acceleration of vesting if there's a merger or acquisition, if you go public, or if you achieve some other definable objectives. Now, cashless exercise. Lots of employees like this. Say your stock is worth $3 a share at the time you grant the option, and you grant somebody options on 50,000 shares. That means that person has to come up with $150,000 to exercise those options. Not many employees will have that kind of cash. But if the shares have increased to $6 from $3 and they had 50,000 options, then he's got $150,000 of equity in there. So if you have a cashless exercise, you can take the equity that's built up in the options and convert that into stock. That's called cashless exercise, so you don't come out of pocket. You might end up with only half the number of shares that you had options on, but you're not out of pocket any cash. So cashless exercise is a big benefit for many employees. Now, options are usually on common stock. That means that they are subordinate to debt and to preferred stock. So the debt gets paid off, and the preferred stock gets paid off, and then finally the common stock gets paid. That's why it's important to look at the terms of the common stock and warrants outstanding, debt outstanding, to determine what the value of your options might be. Special terms, buyback rights. Can the company buy your stock back even if you've exercised or it's vested? Can they buy it back? There might be a buyback clause that will have a valuation formula attached to it. You look at that. Voting rights, proxies. Some options have proxies attached to them, so if you exercise, you can't vote them. That's all a matter of negotiation. Tax issues, ordinary income, capital gain, current income. Now, usually, if you have an option and you exercise it, if it's a qualified stock option, this is for a corporation, if it's a qualified stock option, and then you exercise and hold the shares for a year or 6 months, then you get capital gain treatment, which is great, because the capital gain tax rate can in some cases be 20 points lower. But most people exercise and sell right away, particularly if there's a liquidity event, such as a merger, acquisition, or going public. Then it's ordinary income. Now, if you have non-qualified options, that is, the tax code gives these tax benefits to what are called qualified options. You have to meet certain requirements of the tax code. But an option doesn't have to be qualified. So if you get an option, typically if you can't value it, which is the case in startup companies, then the person holding the option will get income at the time it's exercised, because then you can measure the value of that option. So here somebody has just exercised options and spent $100,000 on options, and all of a sudden he has $100,000 of income he has to report on his tax returns, and therefore you might have to pay $30,000, $40,000 in tax. That's not a very good situation. So options can be very tricky in terms of income. If you got an option and then you had what is called a substantial risk of forfeiture, then sometimes it's not taxable. You have to wait until the restrictions go away. So it's very complicated from a tax point of view. If you are able to value the options in any way, and then you take into account income at the time you got the options, which might be low, then your options themselves become a capital asset and you might get capital gain. And this brings into account Internal Revenue Code Section 83B, if you've heard of that. So consult your tax accountant or tax attorney to make sure you do that right. But it's all very, very complicated, but you have to look at the tax consequences as well. Do stock options work for LLCs? The answer is yes. The tax treatment is a bit different, but options are typically contracts. So any contract that I can write for a corporation, I can also write for an LLC. To do this, you need to have, obviously, a skilled attorney. The LLC ought to issue shares or units. Now, I like LLCs for startup companies. Some people like corporations. I like LLCs. And I actually call the units a membership interest. That's the technical term in the code. I call them shares. Why? Because people understand what shares mean. And I call my managers directors. It's just easier for me, and I think easier for other people to call them shares and directors. It can be confusing if other people use membership interests and managers, but I like to use shares and directors. If you use the shares, it's easier to keep track of percentage interest, dilution, and so forth. If you do it right, the LLC can give you the same or better tax benefits than can corporate stock options. And that has to do with interplay between capital accounts or not. If you have a zero capital account at the time you get shares or options, there's usually no income. Now, sometimes you can grant LLC interests with no capital account and no tax consequences, not income. And then you don't have to worry about options. And you can still have the same vesting, all the other acts. Guild, he can give you whatever tax benefits you want. Okay, alternatives to stock options. You don't have to grant stock options to give people an equity interest. A phantom stock is a form of compensation that can be very attractive to people. They get the benefit of the success without owning any of the stock. Owners like that or founders like that because they don't have shareholders who were voting and so forth. And the phantom stock, for example, if I grant you phantom stock and there is an exit in 5 years at $5 a share, then I have a contractual obligation to pay you $5 for each of your phantom stock. It's not actually stock in the company, but it's measured by the value of the company. That's why it's called phantom. Now, down here, I have this term SARS. That is not a disease. Here it's stock appreciation rights. And that's almost like phantom stock. As the stock goes up, you tie compensation, incentive compensation, to the rise in value of the shares. You can have profit-based plans, a contract where you will get a bonus, more or less, if the company achieves certain profitability levels. Now, you can have other plans, revenue-based plans, keyed to EBITDA. Who knows what that is besides all of the mentors around here? Mostly business owners. Earnings before interest, taxes, depreciation, and amortization. It's almost like cash flow, but to determine the true enterprise value of a company, a lot of financial people look at what is called EBITDA, and then they give a multiple to that. So you can have your bonuses or your incentive payments keyed to EBITDA, cash flow. You can key it to top line revenue. Say you want to hire your top salesperson, your VP of sales, and that person, she says, I can achieve this level of sales, and I want to be compensated on how fast I can grow the top line revenue. So you say, okay, and then you write an incentive clause based on top-line revenue. Now you might want to do it based on gross profit, not top-line revenue, because the board of directors really, they're more interested in maximizing gross profit than in top-line revenue, right? So if I'm the director of sales, perhaps I want gross profit as my mark instead of gross top-line revenue. And there are other factors that you could tie your incentive to in lieu of phantom stock options. Okay, stock options, the magic. This is the magic. When Apple went public, 300 new millionaires were created because of stock options. Now, I want all of you who are entrepreneurs here to break that record, okay? I want you to find a product and go do it so that when you go public or there's an exit, you've got more than 300 new millionaires. And so, good luck in breaking Apple's record. And now you know very little about stock options, perhaps enough in your mind to help you ask the right questions when the time comes. Thank you very much. Now, I'll be happy to take any questions if there are any. For a few minutes, yes, go ahead.
I've read about dynamic equity, maybe before, for a founding team before incorporating, based on contributions of cash and time. Have you seen anything where that works, that a dynamic equity based on contributions?
That's a case in every company when 2 or 3 or more people get together to found a company. So, yes, you say pre-formation, you form your LLC or corporation, you've probably been thinking about it for a while beforehand. That's sort of the dynamic equity. So, at that point in time, get together, decide who gets how much. It's just dividing up the initial equity. That's really what dynamic equity is. Now, if you are the main entrepreneur, if it's your idea that's going to drive this, but you need key people, then perhaps you give them some options, and instead of dividing up the equity among the 3 of you, you keep more of it and give them equity, because you're the main guy who has the main idea. So it's a matter of how much you negotiate with your fellow founders before you organize. Does that help? I think that's basically what you're talking about.
Yeah, I think that's it.
Dynamic equity, I haven't really heard that term. But,
So it's in this scenario where like say 3 co-founders are working on a project and they're foregoing, like you said, their opportunity, the opportunity or money somewhere else. So
Right.
you decide a multiplier on what that person is risking,
Right.
based on, and then cash has its own multiplier, it's worth more. So 4 times cash, say, and then so say I put in $10,000 and 100 hours in a month,
Right.
and my co-founders put in 100 hours that month. Then I have 100 hours plus $10,000 times the multipliers that we've decided over the total contributions of 300 hours plus $10,000. So my equity would be higher. They could come in for 10,000.
I see. Okay. So even after you form the company, you want an ongoing formula to help divide the equity up depending on what the contributions are. That's a lot like the stock option plans. And so yeah, I've seen that before. So what is your contribution is? Whatever your contribution is, you get compensated in equity based on your contribution. We're going to measure that, and so it might be adjusted on a monthly basis or quarterly basis or yearly basis.
Okay.
Yeah, so you can do that. It's a matter of contracts.
It's contract. Okay.
Yes.
At what point in the life of a startup should you consider putting an option pool in place? At the very beginning, after you've hit a
Yeah,
successful
as
milestone?
soon as you need it. So it could be at the very beginning. Now, if you go after professional money, i.e. venture capital money or sophisticated angel money, they're going to make you run through some of these scenarios to figure out how much money you need to.
Go on forever. No, I'm just kidding. But I won't. Okay. Good evening, everyone. And I know that you guys are very hard at work with your ideas, so I hope that